The internet giant, Google, one of the greatest business of all times, has seen its stock price go down pretty heavy this year. While S&P fell 25% year-to-date, Google, a company that usually beats the market every year, has fallen 34%. Currently, Google's valuation is the lowest it has ever been in terms of PE. It raises the question, is this an opportunity of a lifetime? Or is there something bad going on at Google? Get your popcorn ready, because things are about to get Googleicious while we do a deep dive into Google's fundamentals. We will go through all the main factors impacting its business and stock price, both positives and negatives. Also, at the end, we'll calculate Google's valuation to find out what a good buying price would be. Just a quick reminder, this is not financial advice, I'm not a financial advisor. Now, let's begin with the main pros and cons I see for Google. Pro number 1. It's a monopoly. You probably already know Google pretty well. In fact, I bet you use a lot of their services, such as Google Search, Chrome, Maps, Gmail, YouTube, and Android. When you think about all these businesses, and how much ahead from the competition they are, it's pretty clear that Google is a monopoly. Meaning other companies can't compete with them. Small startups can only get bought by Google, or be beaten by Google. Think about search for example, Google owns almost 90% of the market share. Or Android. About half the world uses Android smartphones, which means, basically every business in the world that has an app needs to pay Google. These companies do not only pay monthly fees to be on Google Play, but they also pay 15 to 30% of all revenues coming from in-app purchases on Android phones. By the way, Apple does the same on the App Store. These two companies have complete control of the mobile internet market. And then we have the AdSense business, where they've created a platform that allows millions of entrepreneurs all over the world to make money with ads. And, of course, Google takes a cut on it, making money from every website, YouTube video, and apps that monetize through ads. It's really an incredible business with no serious competition. As someone that has other businesses generating money from ads, I can safely say that all the other players suck at this point. And if you are wondering why, it's because all companies want to advertise on Google. They got the whole world on their platforms. They also have the best tools for advertisers so they can get a good ROI on their marketing and sales. The only two other companies that have something similar for returns on advertising are Amazon and Meta. They've created this amazing moat around them. Even Jeff Bezos once said, and I quote, "Treat Google like a mountain. You can climb the mountain, but you can't move it." Before I jump to pro number 2, let me know in the comments, are you a Google shareholder? Now, let's get into some numbers, and boy, Google has some impressive ones. Pro number 2, revenue growth. As I'm doing this video in September 2022, the 2022 column is considering the last 12 months of revenue as of June 30th. So the 8% growth is reflecting only 6 months. As you can see, Google has never grown revenues below double digits. Their worst performing years were 13% growth in 2020, during the beginning of COVID, and 14% in 2015. Most years Google grows more than 20%, and last year, 2021, they managed to grow 40%, which is crazy to think about, considering their size. Some of the cons I'll mention later on the video might have an impact on the short-term growth. So I wouldn't expect very high sales growth for the next few quarters. However, Google has shown an incredible ability to grow revenues consistently year after year, which makes me believe that in a 5 to 10 years period, their average growth will be pretty good. So I'm considering a big pro here. Pro number 3, healthy balance sheet. Google definitely has one of the best balance sheets in the world. They are currently sitting at a massive pile of cash, of almost $125 billion. Which is more than enough to pay all their debt, if they want. Google's total debt is $28.7 billion, when you add both short and long-term debt and leases. And they are also a cash flow machine, generating $95 billion in operating cash flow on the last 12 months. This puts Google in an extremely privileged position that almost guarantees their lead going forward. They always have a ton of money to buy other companies, invest in their future businesses, and return value to shareholders through share buybacks. Pro number 4, Google Cloud. If you watched my Microsoft video, you know my position on the cloud business. If not the best, it is without a doubt one of the best businesses to be in right now. Every online company needs it. It's a great scalable recurring revenue business model. And as the costs to build a business like that are incredibly high, only a handful of companies in the world have the ability to play this game. And they have been growing fast. Google Cloud's revenue for the last quarter was $6.3 billion, a 40% increase when compared to the same quarter of 2021, when revenues were $4.6 billion. If you want to know more about the cloud business, I went a bit deeper on my Microsoft stock video. I'll leave a link in the description here, in case you are interested. Pro number 5. Other bets. One of the great things about Google is that they are always building a lot of new cool stuff, and also, investing in awesome startups. In 2009 they've launched Google Ventures, and have invested in hundreds of businesses since then. And of course they won't hit home runs on all of them, but they are pretty good at picking these investments. Just to name a few startups Google invested during early stages: Uber, Slack, Stripe, HubSpot, DocuSign, and GitLab. But the most exciting project they have is Waymo, the autonomous driving technology company. Obviously they will face serious competition from Tesla. Apple also announced they are working on an autonomous car. But this kind of technology takes many years of developments and real testings. At this point, I believe Waymo is ahead of the competition. They have over a decade of autonomous driving experience. Waymo One is their robotaxi service. It has been taking passengers without a human driver for the past 3 years in Phoenix, Arizona. They are also operating in San Francisco, where drivers behind the wheel are still a requirement. And to make it all better, there is Waymo Via, their autonomous driving solution for moving goods. They are currently testing Class 8 heavy-duty trucks in California, Arizona, Texas, and New Mexico. And are also testing local delivery in Arizona with their fleet of autonomously driven Chrysler minivans. Pro number 6. Low valuation. As I mentioned in the beginning of the video, Google's PE has never been lower. For a company that has the historic growth Google has, an incredible moat built around all its products and services, and a likely bright future ahead, 18 PE is incredibly low. You won't find such a quality company at these levels in the market. Making a quick comparison, Apple's current PE is 23. Microsoft has a PE of 25. Amazon has a PE of 47. Meta is the only American big tech with a lower PE, of 11, due to a bunch of headwinds they've been suffering for the past few quarters. By the way, I'm also leaving a link in the description for the video on the pros and cons of Meta stock. Let's take a look at what analysts are thinking. If we go over Yahoo Finance, we can see they are rating Google stock from buy to a strong buy. And their average target for the next 12 months is $149, representing a 57% increase from the current price. On Seeking Alpha we find 51 analysts rating the stock, with a strong buy recommendation. Their average price target is $140, a 47% increase from current prices. Later on this video I'll show my personal valuation and how I got to it. Spoiler alert. I calculated 3 different scenarios, and one of them shows a 111% upside potential, just to get to fair value. Now, let's get into the cons, my main concerns for Google stock. Con number 1. Highly concentrated in advertising. Although Google has all these great products and services I've mentioned, most of their revenue comes from advertising. When we sum up all advertising services, Google Search, YouTube Ads, and Google Network, we get to a total of 81% of the revenues coming from advertising. Just in case you are wondering, Google Other represents a bunch of services like YouTube memberships, in-app purchases on Android phones, and Google Chrome. I don't mean to criticize the advertising business, I think it's a great one. But, it isn't as reliable and steady as a company like Microsoft for example, that also has a lot of products and services, but less concentrated in most of it generating income from recurring subscriptions. In times of recession, companies tend to cut costs on advertising, which we are starting to see now in 2022. So, what's Google doing? Cutting costs wherever they can, and trying to improve its productivity. Something similar to what's going on at Meta. Con number 2. Antitrust issues. One problem Google has in common with all other big tech. They got so big that governments are constantly penalizing them with fines related to antitrust issues. which often is not that big of a deal. They are usually a few $1,000,000, nothing compared to the $95 billion Google is generating per year on operating cash flow. But it's not always like that. Google lost against the European courts and will be forced to pay $4.1 billion in fines. This case started in 2015. It relates to Google imposing unlawful restrictions to consolidate the dominant position of its search engine. Con number 3. Google Cloud. As much as I think the cloud business is amazing and that still has so much potential ahead, Google has 10% of the market, behind Microsoft Azure, with 21%, and Amazon AWS, the company that dominates a third of the market. And if we look into Google's segment results, we see that only Google services generate actual profits for the company. A negative result on other bets is totally expected. But losing money on cloud, where Microsoft and Amazon are making the most amounts of profits, is a pretty hard con. Great. Now that we know more about Google's business, let's crunch some numbers and see what a good price to buy would be. I built a discounted cash flow model that evaluates companies considering some key data going forward that we input according to our expectations. It is important to note that the variables we'll use consider the next 5 years. And the data need to input are revenue growth, share change, profit margin, PE ratio, and expected returns. I also use 3 different scenarios, where the base case I consider to be somewhat conservative, not too bearish of bullish, numbers they will probably achieve. For the best case scenario I'll be more bullish, assuming less probable premises, but still possible. And for the worst case, I'll be bearish, and consider what I think is a remote chance of happening, but again, still possible if things turn south. 4. Revenue growth. As we saw earlier on the video, Google has never grew less than 13% in one single year, and often grows more than 20%. As we are in very uncertain times and have already seen the advertising market getting hit, I'll consider 16% for the base case scenario. For the best case, I'll do 20%, assuming things get better soon, the cloud business keeps improving and some of their other bets starts to pay off. And for the worst case, I'll use their worst year in history, 13%, as an average for the next 5. Share change. Changes here can always be positive or negative, through the company issuing more shares to raise money, or by doing share buybacks, reducing the amount of shares in the market, and consequently, increasing shareholders' position. So, it's a little weird to see, but a positive change here is bad, while a negative change is good. As Google doesn't need to raise money and generates lots of it, they do share buybacks. And looking at Google's share buybacks record, we can see they started repurchasing shares in 2018, less than 1%. But they have been increasing the amounts, getting to above 2% on the last 12 months. Although I do think they have good chances of averaging 2% or more in the next 5 years, I don't want to risk being too optimistic, so I'll consider 1.5% on the base case, around the average they did over the last 3 to 4 years. For the best case, let's say they maintain an average of 2% per year of share buyback. And for the worst case, I'll do 1%, considering a little drop from today's numbers. Profit margin. Google used to have a 22% profit margin until 2019. In 2020 they had that big 40% revenue jump, leading their margins to an outstanding 29%. But, we've already seen it going down this year and is now at 26%. As they are currently cutting costs and trying to improve productivity, I believe this is a pretty reasonable margin going forward. So I'll do the same 26% for the base case. For the best case I'm considering 2 percentage points higher, 28%. And for the worst case, also 2 points from the base case, but in this scenario, lowering to 24%. Price to earnings as we've seen today, Google's PE is usually above 20. But keep in mind that here we need to estimate what the PE will be in 5 years. And as the company gets more mature, it is likely to slow a little bit the growth, and consequently the PE drops a little. Note that I said likely. It does happen that huge mature companies keep growing and get a higher PE, which is the current case for both Microsoft and Apple. So, having said all that, for the base case I'll consider 18, which is below Google's average historic PE, but is still above the market average, and I think it gives a little safety net, considering the current macroeconomic scenario. For the best case I'll do 21, which I think is actually pretty fair for a high-quality company like Google. And lastly, for the worst case scenario, I'll consider the market average of 15. I just don't see Google below market average. The last input we have to make is the expected returns per year. I use 15% for all scenarios. I believe it's a great performance when compared to the market average of around 10%. It also gives me a good safety margin, in case I'm wrong on these assumptions. Okay, now that we've went through all the assumptions, let's find out what a good buying price would be considering each one of the scenarios. For the base case scenario, the one I think it's the most likely to turn out, we got a fair value of $137. This means that if our assumptions are correct, there is a 43% upside potential here. The price we got on the best case scenario is $203. If this turns out to be true, then Google's stock price should increase 111%, just to get to fair value. And to be honest, I think it's perfectly possible for Google to achieve these numbers. To finish up, we have the worst case, where the fair value for the stock would be $95, pretty close to what it is today, a 1% difference. So I believe the market is already pricing in a bad scenario. Which is not bad in my opinion. If our assumptions are correct, there's only upside from here, with very little to almost no downside. Keep in mind that the market is unpredictable, especially in today's environment. Prices can always go lower and our assumptions can also turn out to be wrong. So, be careful out there, do your own research and due diligence. That's it for today folks, hope the video was helpful. Don't forget to like and subscribe for more videos like this. I'll see you in the next one.